when it comes to investments, it is more than just simply selecting the right stocks or selecting the right investments, but it's about looking at the overall health within the economy. This is why we have economic indicators. Economic indicators are signs. They will basically give you an idea of the direction that the economy is headed into so that you as investors can make adjustments. For example, when you look at things like asset relocation, when you look at timing, and when you look at the type of risk that you want to take, it's a really good idea to follow the economic trends and the indicators so that you can make adjustments, because nobody likes volatility. Nobody likes to lose a lot of money. So by looking at these indicators, you will be able to make adjustments, and you will sort of be able to hedge your way so that you provide a cushion in terms of where your money is headed in terms of your investment portfolio. So we're gonna look at the top indicators that you can make as investors so that you can determine the direction that you would like your investment portfolio to take and make the necessary adjustments. But first, if you haven't met me before, my name is Leon Mann. I'm a licensed wealth consultant with Money Assist Financial. And what I do, I basically help hardworking folks such as you, add an additional multiple 6 to 7 figures to your retirement portfolio. We're able to do this by providing a free, no obligation, comprehensive financial analysis so that you can basically determine where you want to go based on where you currently are. Together, we're there to help you to design the roadmap and to design the lifestyle that you would like to end up. When you look at the economic indicators, the first most important thing that many investors would look at is the GDP, or the gross domestic product. The gross domestic product basically is the total amount of goods and services that the economy will produce in a given month, for example. So if the GDP has a high increase, then it indicates that the economy is booming. It indicates that people are spending and profits are being made. And another thing, you will see the investments in the green side, right? Many stocks would be going up. When the GDP is declining, as a matter of fact, if you have 2 quarters of declining GDP, that is 6 months of declining GDP, this is a strong indicator that a recession is close by. So that you as an investor would be interested in making the adjustments according to how you would like your portfolio to be, right? Whether it is asset relocation, whether it is adding more defensive-minded investments in the process. So a GDP is a very good indicator of the direction of the economy. Pay close attention to this. The second thing is inflation rates. Now, when the inflation rates are normal, it's nothing to worry about. But if you find that there's a sharp increase in inflation rates or a spike in inflation rates, it could indicate problems down the road. If you have high inflation rates, people are less likely to buy things. Stocks are going to go down. The economy can basically be coming to a standstill, right? The economy can really slow down when the inflation rates are increasing. Now, there's a couple of things that would perform really well. For example, you have real estate, you have commodities. These investments would usually perform well when the inflation rates are increasing. On the other hand, if you have investments such as GICs, if the yield of these investments are lower than the inflation rate, it can be a pretty bad thing for you as an investor. So you want to know what to purchase in terms of investments when it comes to higher inflation rates than normal. So pay close attention to inflation rates. The third thing is interest rates. It is up to the central banks. They can control the economic activity. They can control the inflation rates. As a matter of fact, when the interest rates are going up, then people are less likely to borrow. They're less likely to spend. It can really have a negative impact on growth investments or investments that were supposed to be on the rise, right? Stocks can go down when interest rates are on the increase. On the other hand, when the interest rates are decreasing, yes, it could stimulate a lot of spending, but on the other hand, it could also indicate a weakness within the economy. So there have to be like a balance between the up and down, but there have to be a somewhere in the middle. There have to be a balance. It cannot get too low or it cannot get too high. This is why the central banks, they're there to control the interest rates so that it basically puts the economy in a good balancing position. The fourth thing is employment data. Many investors would look at the employment data. Is there job creation being made currently? Are people laying off a lot of people? All of this can signal a couple of important things. When the unemployment rate is up, people are less likely to buy things. For example, they're going to be less profits being made. When the unemployment rate is down, on the other hand, then people are going to buy more, right? Profits, corporate profits are going to be made, and stocks, they're going to be in the green again, or they're going to be going up. So when it comes to economic data, you want to pay close attention to what is happening in terms of job creations, in terms of people getting laid off or people getting hired. Because if a lot of people are getting hired, if jobs are being created, it's a very strong indicator that the economy is headed in the right direction. The fifth thing is consumer confidence. Confidence is what drives supply and demand. If people are less confident about where they stand financially, they're less likely going to purchase stuff. It could indicate an economic slowdown. They're going to be less profits being made, and it's not going to be a healthy economy. It's going to be an economy on the decline. On the other hand, if people are confident about themselves financially, they're more likely to purchase things, goods, and services. The economy is more likely to experience a boom or an increase in terms of supply and demand. So investors would usually pay close attention to consumer confidence so that they can actually be able to have an idea where the economy is trending and make the necessary adjustments according to how they would like to make adjustments to their investment portfolio, whether it's asset relocation, whether it is high risk, low risk. All of these factors can basically be able to at least control volatility when it comes to your investment portfolio in order to keep it balanced, right? So once again, economic indicators, they're strong signs to warn us of what is trending and what not to do when you have GDP, when you have interest rates, when you have inflation rates, when you look at the consumer data, when you look at consumer confidence. These are strong indicators. So this concludes the presentation for today. By the way, if you have any questions, feel free to drop it down. Also, feel free to subscribe. It is free to subscribe, and click on the bell notifications. Every time you see the bell notifications, click on it. You will be directed to a new video. So I thank you guys for tuning in. Until next time, I wish you guys all the very best. Peace and love. Take care.